Hello, everyone, and welcome to Economics Unplugged with Prof. Raj. In this podcast, we engage in insightful conversation with leading economists and esteemed professors, exploring the complexities and dynamics of the Indian economy. Join us as we unravel the nuances behind the numbers and make sense of ever-evolving economic landscape. So today I have honor of hosting Dr. Sahana Roy Chowdhury, a professor of economics at International Management Institute, Kolkata. With a profound research interest in labor economics, fiscal policy issues, and public policy. She contributed significantly to the Expenditure Management Committee established by Ministry of Finance in 2014, where her research inputs played a crucial role. She is also the editor-in-chief of the SAGE Journal, which is one of the journals in macroeconomics. Her expertise has been recognized on various platforms, including her role as an expert panelist at the Center for Policy Research in Higher Education, and among numerous other accomplishments. So I would like to welcome Dr. Sahana Chaudhary. And in today's episode, we will be discussing in India's current monetary policy stance, especially in the light of the recent development on 7th Feb, when RBI reduced the repo rate by 25 basis point to 6.25. So we will delve into how the Indian economy is poised to navigate global challenges, including the tariff issues, economic growth, and inflationary pressure. So let's gain some valuable insights from Professor Sahana as she shares her perspective on these critical economic dynamics. So thank
Okay.
you so much, Professor Sahana, for joining my podcast, Economics Unplugged with Praful Raj.
Thank you, Praful, for inviting me to share my insights.
Yeah, it's
Uh,
honored, ma'am. So as we know that we'll be discussing about the monetary policy stance in the current economic scenario. So my first question is like, how is the current economic monetary policy positioned in response to global economic challenges? Like, is it adequate, aligned with the factors such as the U.S. reciprocal tariff that may come, and also India's export risk due to the expected global slowdown this year?
okay. So, very good question, interesting question. Yes, the global economic scenario is very different this in this timeline, and it's undergoing massive politico-economic shock, I will say. And emerging market economies have been hit by this Trump 2.0 policies in particular, which are yet to get unfold and which will be coming soon as the announcements are there post April 2. So very recently, possible impositions, there are announcements which will be imposed later of 25% tariffs on automobiles, semiconductor, pharmaceutical imports, which have a long supply chain spread across many countries. So basically, if really I have to say one word to this difficult scenario globally, it is uncertainty.
So, as you mentioned about like different tariff rates, so is that India will be implementing the tariff, or like how? Because on the US side, they have mentioned about the 25% on steel and aluminum products and everything, and also the reciprocal. And they mentioned that on the reciprocal tariff, they will be seeing the particular HSN number code, which is same across the world. So what will be the few products, as you mentioned, is from India or US side?
Yeah, so India, I don't think India will impose any fresh tariff as a retaliation because this has been a reciprocal tariff. So, in fact, in the if you follow the recent budget, seven tariff lines, the tariff has been reduced. So, one cannot really say whether this is the Trump 2.0 effect, but definitely India's tariff has been quite high in comparison with many other countries, directly or indirectly. I mean, there are points, there are discussions that there are non-tariff barriers as well. The kinds of subsidies India provide to protect the domestic farmers, for that matter, PLI scheme. These are under consideration, under discussion that should this be counted as NTB. But coming back to the tariff, definitely no retaliation will be observed, and that is why the diplomatic conversations have been there with PM Modi and Trump. And but there will be definitely some strategic moves to face this head on. The imposition of tariffs on India. India has been defined as tariff king by Trump. So definitely some strategic moves will be there to
Yeah,
counter
I
this.
think as a developing nation, we have to protect our domestic manufacturers. So probably it has been seen that the developing countries have generally more tariff as compared to developed countries. So in that, coming back to the second part of the question, so as we know that on 7th Feb, the RBI reduced the repo rate by 25 basis point to 6.25. So how that is going to help us in due to the global slowdown that we can see, so how our economy will get impacted, and is this the reason that has the repo rate has been decreased to 6.25, and further also we may see a cut because we want to boost our economy, the consumption which has slowed down over years.
Yeah. So 2 points come under considering stability, the global headwinds, and how far the monetary policy, recently announced monetary policy, is going to be helpful. So if I talk about the growth front, the stability at a time when this turmoil is happening. So if I can quote from the monetary policy statements, the minutes, the RBI governor said that the CAD, current account deficit, for this year is expected to be remain well within sustainable level. And as of now, to go quote some number, 31st January this year, India's forex reserves stood at 3630.6 billion USD. So which can provide import cover of over the 10 months. So overall, India's external economic scenario and other indicators are quite robust, according to the MPC committee minutes. So basically, if you look into the other fronts, financial sector, it is quite resilient and robust. And the objectives of RBI is very clear. It is to maintain orderliness and stability without compromising any market efficiency. So interventions will be there in the forex market, because as and when you are facing this capital outflow, massive capital outflow, that has happened very recent timeline by a very large extent. In 1 month only, FII, FPI in January, if I can quote you the numbers, in 1 month, this has happened to the extent of 50,000 FIIs have withdrawn 50,000 rupees crores from India's stock market in the month of January 2025. So impacting Sensex and Nifty. So the capital outflow has been massive. Definitely repercussions has happened on depreciating rupee vis-a-vis dollar. And coming to the monetary policy, it has given a boost to inject liquidity in the system. Simultaneously, this capital outflow has created pressure on rupee, and RBI had to intervene. Directly or indirectly, there have been so many strategic moves starting from September onwards. And December, we have seen very different kind of strategic moves to defend rupee falling further. Given this, definitely there are concerns that liquidity withdrawal will happen because of RBI's intervention, and that might defeat the purpose of liquidity injection,
Yes.
stimulate the growth.
So on that, on as you mentioned about the forex and the liquidity, so my question was related to that only. So I will just like to quote one number that in the forex market, RBI sold around last 5 months from their reserve of $704 billion to it has reached to $630 billion. So my question is on that, the RBI has been actively selling its foreign exchange reserve now to prevent the sharp depreciation of the rupee. But this involves supply of forex to banks in exchange of rupees, which effectively is tightening the monetary policy. So, however, I mean, The central bank has eased monetary policy by cutting the repo rate, which intends to increase the money supply, expand the money supply. And on other hand, due to the selling the forex to bank, I mean, it has the rupee will, of course, the portion of rupee with the Indian banks will be less. So how do you see how this can unfold in near future, in next 6 to 12 months? What do you think on that?
Yeah, definitely. This is a point well taken, and concerns are there. That there is cost to intervention in the forex market to defend rupee. So RBI's constant intervention, which is, as you have correctly said, has been obvious, and they squeezed out liquidity.
Yeah.
So this tightness might make the recent easing of monetary policy ineffective, so long as there is no further injection of liquidity in the system. So surplus liquidity conditions are prerequisites for effective transmission of lowering the rates,
Yes.
so that banks can also lower the lending rates. So if I can already mention, underscore this point, as you have correctly mentioned, the Indian banking system liquidity deficit, the minutes of the monetary policy also kind of mentions that, has quadrupled to the tune of 2 trillion rupees in February 11 this year. So, given this, and with kind of many reasons are there why this is happening. Liquidity, the banks are falling short of. So simultaneously, RBI, as you have said, has been intervening through open market operations and other many different kinds of routes RBI has been taking to sterilize this intervention. So yeah, but if I can go deeper further. One can explain this using the concept of the impossible trinity. We all study this, learn this, and teach to the students the impossible trinity, that a country cannot really have a choice of having a capital market open, independent monetary policy, and at the same time fixed exchange rate. So I'm not saying that India has moved to the flexible floating exchange rate regime post 1993, but to maintain rupee dollar in a particular band through desperate interventions has a cost itself. It cannot be a choice. So the independent monetary policy, the rate cut will be defeated by squeezing out liquidity from the system. So there has to be a continuous process of innovative mechanisms to inject liquidity further, so that India can maintain the independent monetary policy, because inflation has been a concern, and the biggest concern is that growth has not really been taking off as expected.
Yes.
So stimulate growth, that's necessary.
So if you have to summarize this, how would you summarize, as you mentioned, that it is a kind of balance? We cannot have independent monetary policy and then fixed exchange rate. So how do you summarize this for our audience to understand exactly in 2-3 lines?
Yeah. So basically, see, India's priority at this moment, as we have seen, the budget also have underscored and kind of made the process very easy. So it's a combination of fiscal and monetary policy that will work to boost up growth. That's the topmost priority, because inflation is under control. And core inflation also, it has gone down. It might increase, but it will be moderate, as the MPC minutes have also mentioned. So, but right now the concerns are why the growth has been really low. So, are there some structural issues that exactly the combination of fiscal and monetary policy is trying to find out, while RBI has been intervening in the market to defend further, complementary actions of injection of liquidity, so that the rate cut can be transmitted further through lending rate cut. They're working on this process. But given the structural factors are real concerns why the growth is not really picking up, and the economic survey has also mentioned that the corporate India is riding a wave of record-breaking profit, whereas wages are not taking off. Wages, the share of wages have gone low. Given that consumption in urban and rural areas are dampened little bit, consumer pattern of consumption has changed. So basically highlighting and underscoring the growth prospects and whatever policies are needed in collaboration with the fiscal and the government in the monetary policy makers, are must be there to stimulate growth, and that's the topmost priority right now in the Trump 2.0 era.
Yeah, it's kind of balancing the act of balancing actually. So, I mean, the steps have been taken by RBI, and as you mentioned, that it's a mix of both monetary and fiscal policy. We cannot stand. It's a balance act of balancing. So, from your perspective, from if I have to ask from your perspective, what do you think? What key measures should RBI implement to effectively these these global headwinds and ensure stability while maintaining inflation under control?
Yeah. So, in my opinion, this aggressive intervention to defend the rupee may be balanced out a little bit, because it might. So, first of all, as already many researchers have been pointing, that unnecessarily, intervening in this to appreciate rupee. This has been depreciating further, will create moral hazard problems, because already the many of the banks and NBFCs, they are having unhedged exposure of their balance sheet. So they will think that RBI is there to intervene, and I need not, because hedging is costly. So they won't do that. Rather, to find another equilibrium for the rupee dollar exchange rate to settle down, and wait and watch policy is much needed. So, what the repo rate cut has done extremely great to stimulate growth, which is the need of the hour, and budget also did walked in the exactly same direction. So, in my opinion, aggressive intervention complemented with further injection of liquidities to different channels, which are also in discussion, might be balanced out. So, priority number one should be growth.
Yeah, so according to it was like kind of necessary. It was required to maintain that. So one very basic question. So we are talking about like how our rupee is getting depreciated and RBI is trying to appreciate it or maintain the balance. So like what are the impacts that directly seen by the consumer, directly like faced by the consumer due to the depreciation in rupees? What are few impacts, like direct impact with consumer feel?
So, consumers, if you talk of the exporters will be really happy
Yes,
if a depreciation
yeah,
is
talking about
happening.
importers basically, how
Yeah,
importers.
importers, correct. So, but there are another point that it will lead to imported inflation, because if importers are getting the pinch, then they will look for some alternatives. I understand many
Yes,
importables cannot be substituted. We do
yes,
not produce them domestically, but imported inflation is the fear. I understand inflation is not a big concern right now, but in the medium run, it could happen, and that is why some structural factors need to be, corrected, as government and RBI in collaboration are really working on that. For example, so that the transmission mechanism of cutting the lending rate from starting from the repo rate cut actually happens, and it reaches to the MSME sectors, which are in dire need of credit, right? So that needs to be corrected. And at the same time, imported inflation, if it goes beyond limit, one really has to look into that. And further, another point in the Trump 2.0 era is that there are possibilities of people are, seeing this, that of dumping, because if China cannot really export US, and given their excess capacity, so PLI schemes need to be properly strategically corrected at this moment, so that these possibilities can be ruled out.
yeah. So, as per you, you think that there might be some supply shock. There might be some supply shock that we can see because of rupee depreciating, and which can be transferred to a consumer in a form of inflation, if we understand it correctly, right? Okay. So since we are talking about inflation, we'll talk a little bit more on the inflation part. Kind of a same question, but in a more systematic way. So I'll just mention few numbers. For example, as of January 2025, the retail inflation stood at around 4.31, which has declined from 5.22 in December 24, which is definitely a progress. And in November, it was 5.48. So it has declined. Now, this drop was primarily driven by a decline in food inflation, which fell from 8.39 to 5.33 because we had a good crop this year, good Rabi crop this year, strong harvest. So, however, core inflation removing the energy and the food, inflation has not declined much. Relatively, it's remained at 3.58, from 3.64. So in that term, because harvesting and the core inflation is something which needs to be come down for overall retail inflation or the headline inflation to come down. So what do you think, like, is current inflation rate is manageable at a manageable level, or what do you think, what measure beyond policy, monetary policy, can help ease inflationary pressure, especially for the middle class and a lower class group? Because we say like life is still pricey, numbers come down, but the cost of goods that we use on a daily basis remains expensive. So what do you think on that part? What's
Yeah,
the
yeah, definitely. It's a very interesting point that core inflation. But if you look at the number, 3.58 is not a big number. It's in the comfort range, right? So, and on the other hand, the global commodity prices are softening for many political situations are getting corrected. Ukraine war and all these things are getting mitigated a little bit. So, as per World Bank's report, also commodity prices are softening. If we look at the core inflation, many people are saying that it is distressed demand driven, but not really that is the case. Rather, if you dig deep, you will find that core inflation is weeding out the energy and food prices. As you have said, the
yes.
inflation was being driven by food inflation. If you look at the core inflation, food and energy prices are separated out from this. So basically, in both rural and urban areas, you will see that goods and services that are essential in day-to-day living. Okay, so that are very much included in this. So if that is the case, that it is distress and demand needs to be injected because of lack of demand, this is happening. That's not the case at all. So that is why people are saying that many economists have pinpointed also this, that it is a shift in the consumers consumption pattern that is doing this, that is causing this. And so long as core inflation is in that range where it is now today, it is not a worry point. So perhaps people's activity using e-commerce websites and rather than physical transactions are also triggering this, which is also a change in the pattern of consumption, right? Nothing to do with the distressed demand. So in any case, the budget and the monetary policy in collaboration, that we can see what they have done to stimulate growth, and the overall the demand scenario to stimulate that is going, that's, I think it's a balanced act.
You're right. I understand that consumer demand has shifted. But one thing I would like to know from you, and this is my assumption, I may be wrong. See, the consumer demand has shifted to products which are, healthy products, more expensive product, because nutrition-based product, organic-based products, and that we have seen, like all the big FMCG companies has also mentioned that we have seen a decline in a profit, especially in the urban area. So, and we second point that we also know that the inflation component, which has not been changed, the component has not been changed for last many years. So what I mean to say, that new organic or healthy products might not has been introduced in the component of calculating inflation. So is it due to that, as you mentioned, the many economics are talking about, decline in consumption, and it is not demand driven. I mean, no, we see a disinflation, I mean decreased demand. So is it because the middle class has shifted to upper middle class, and they are buying a high quality products which more expensive, which is kind of not included in inflation. So that is why the core inflation is stable. But if the inflation components are updated later on, we might see a good shift. Is it a correct way of approaching this?
Yeah, yeah, I got your point. So, yeah, absolutely, because there needs to be a correction in the goods and services, the basket of goods and services that are typically consumed needs to be updated. I completely buy this point. And that might reflect with precision where we stand today, and accordingly, the strategies can be made. So there has been a definite drastic shift, and the base period needs to be changed and corrected. The kinds of patterns change that are changing both in urban and rural areas, and
Yeah,
definitely that's the point. People are moving up in the
the
income ladder,
classes
and
higher level,
by
yes,
yeah,
yeah.
yeah, yeah, definitely that is why this awareness and the pattern, their preferences, their choices, that is not really reflected in the current weights that we see in calculating the core inflation.
Last question, Professor. Overall, we have talked about inflation, how RBI is taking to maintain the rupee depreciation and everything. So overall, what do you think about how the Indian economy is performing? In terms of consumption, in terms of mitigating the global slowdown, which will have some impact on the Indian economy. And overall, that we have seen that the foreign institutional investor have taken quite a lot of money from the stock market. So since economy is not independent of these things, it's a mix, and it's always an act of balancing. So what do you think in that perspective? Where are we going? What are two, three critical things that you think of that?
Yeah, so it's undeniably true that this is the turmoil timeline, especially the Trump 2.0 era, because fresh tariffs and all these things, and India is one of the top list in his list. But this is also simultaneously true that growth is not really where we expected that to be. But India is quite resilient, and there are a whole lot of evidences. The monetary policy also, all the monetary MPC members have categorically mentioned that we are resilient in the sense, and robust fundamentals are there, so that even the growth is not showing right now. We are in the comfortable zone in the sense that as compared to many other EMEs. So these shocks are there, and we are resilient to go back to the trend where we have been. It's a timeline of where the strategic interventions with good combination of policies will help, because exports markets are really suffering because of these factors, our export markets. So if we at this moment can look into the other structural factors that are causing problems to our internal demand situations, that will help. For example, consumption, personal consumption expenditure has been one of the largest contributor
Largest
into
component
from
of
different sides.
GDP, yes.
Yeah, so that has not gone really down. So it shows that we are not very differently performing right now. Whereas I understand the export scenarios, everyone else is suffering because of this situation. So coming back to the withdrawal of capital outflow that is happening, it is because of the Trump and dollar being
Dollar
the
appreciating, yes. Yeah.
appreciated. So that's definitely some mitigating policies must be there, but too much of intervention, I am not really in favor of that. Let the new equilibrium be settled down somewhere, right? So that the FII and the banks, NBFCs understand where we stand today, and they will strategize accordingly. But overall, the scenario is definitely economic shock is there. I'm not denying that, but not really bad situation for India. Growth needs to be stimulated, number one, and that's there.
That's
The policies are.
okay. So I think overall we say yes, the time is uncertain and there's a lot of turmoil happening. But according to you, we are also resilient, and we are trying to mitigate it as much as you can. So yeah. So thank you so much, Professor. This was quite an insightful conversation, and I hope my viewers will like this podcast, and probably they might have some question, and they will comment for those questions. So thank you so much, ma'am.
Thank you, Praful.
Thank you so much for listening my podcast. Please like, share, and subscribe. See you next time.